Hello, everyone. To all 14 people that they are here. Hopefully, you can hear me, see my screen as well. So, I would like to welcome you first of all to this webinar. It's actually one of the most important webinars in that we offer because it has to do, as the title is saying, with for understanding the market basics. So we're gonna go through the fundamentals before someone starting to trade, before someone becomes a trader. So it's the things that you must know, you must very well experience and understand on those topics that we will cover today. There will be a follow-up next week with Stuart, and the understanding basics part 2. So you are more than welcome to join us as well in the next session that will be next week with a bit more advanced one, just the continuation of this one. So guys, can I have a quick feedback, as I always am asking the people that are attending my webinar, just a quick feedback, whether you can see me, hear me, see my screen as well. Just a quick yes or a no. I always do that because I want to make sure that I'm not here alone talking to myself. Just quickly, until I have a response, I will go through the admin because we have a lot of things to cover. So great. Thank you, Henry. Thank you, everyone. August, students, Ali, thank you very much. So I will go through the admin as usual, and we could quickly start. So this material is provided as a general marketing communication for informational purposes only and does not constitute an independent investment advice, research, sorry. Nothing in this communication contains or should be considered as containing an investment advice or an investment recommendation or solicitation for the purpose of buying or selling of any financial instrument. All information provided is gathered from reputable sources, and any information containing an indication of past performance is not a guarantee or reliable indicator of future performance. Users acknowledge that any investment in leveraged products is characterized by a certain degree of uncertainty, and that any investment of this nature involves a high level of risk for which the users are solely responsible and liable. We assume no liability for any loss arising from any investment made based on the information provided in this communication. These communications must not be reproduced or further distributed without our prior written permission. Trading leveraged products such as forex and derivatives may not be suitable for all investors as they carry a high degree of risk to your capital. Please ensure that you fully understand the risk involved, taking into account your investment objectives and level of experience before trading, and if necessary, seek independent advices. Please read the full risk disclosure. So admin is out of the way. Have a great day ahead, Eric. Thank you. So, oops, here we are. So in this, this is a webinar actually that it's the second time that we repeated in 2019, and this is because of its significance. Okay, even me, I have to go through some of these topics in order to understand, in order to improve myself, especially as a trader. So in this first webinar, this first part of the understanding market basics, we actually want to give you a better understanding on markets in general and how you can proceed with your market analysis. And this webinar actually has been designed for people that they are quite new in trading. Is any one of you guys a quite a new trader, like the past, just for a year, maybe less than a year, few weeks maybe? Why not? So is any one of you or a new in trading and in markets? So, okay, I don't have a response yet, but just for people that are a couple of years or so, August, you are not a new person or a new in trading, so you are uh, um, you're a veteran, let's say, in trading, if you're saying a couple of years. But if you don't find anything interesting in this webinar, I will then advise you to attend on part 2 with Stuart next week, okay? So, cool. Less than a year, still learning. Oh, that's very, I appreciate that, August, that you are saying that you're still learning, because we will still learning again and again, like forever. So the fact that you're not claiming that you're fully capable and you know everything, that's a good sign, because that means that you respect the market, you respect your money, and you want to learn in order not to reduce the risk of your investments. That's good. Bravo, bravo. That's very good. New, less than a year. Great, guys. So let's quickly start then. I'm talking a lot. So we'll see human emotions and news. You know that markets are actually um, getting the direction based on human emotions, not only on the news. It's us that we're taking the market. We're like driving the market. It's our perspective of the market which it's applying our trading. So human emotions and news and how they affect the market, how fundamental and technical analysis differ, what's the difference between how you should what each one of these analyses are and how they could help us, circles in nature markets, price charts and how to read them, price trends and sideways moves, and last but not least, moving averages and Bollinger Bands, two of my favorite indicators to be used. So just as an intro, I would like to welcome you in this webinar by saying this phrase from Benjamin Franklin, one of the founding fathers of the United States. So he was, among other things, a scientist, an investor, as well a businessman and a politician. So one of the most famous quotes from him is, "By failing to prepare, you are preparing to fail." I think that phrase says it all. This is what we mean, especially Stuart is repeating it again and again. Risk management, and be ready to fail as well, because what matters is not that you failed today, you lost, I don't know, $1,000. What matters is at the end of each month, or at the end of the week, or at the end of the year, depends on your trading journal, but depends on you. At the end of the month, for me it's a month, at the end of the month is your overall trading to be on profit. You will have some losses, but you will have some gains, so the gains must be more than the losses. So you need emotionally, psychologically, you need to be prepared to fail, because we are not gurus, we're not mediums. So you need to be prepared to fail. Okay, so, and also by failing to prepare, you're preparing to fail. So what that suggests, that if you're not prepared yourself by checking the news, reading the economic calendar, reading an analysis from famous economists, and etc., before you enter a trade, before you enter the market, you're not prepared for your trading, so you're not aware of what's going on. So that's a confirmed failure. So always have a training journal, always go through the news, through the economic data every day, every morning before you enter the market. Okay, this is how you will get well prepared, and you will have a more a complete, clear picture of the market at the particular moment that you will enter. So that's why we're here today, to learn and to prepare as well as well as we can. Okay, So even the fact that you are here attending the webinar, that tells me that you are here, that you have a very kind attitude for succeeding in the market, succeeding in trading, because you are here and you are ready to learn. That says a lot. So just out of the blue, just to highlight over here that one of a very, very successful institutional fund managers said that he spends 99% of his time preparing to trade and just 1% of his time in actual trading. That's why the preparation is so much, and that's why that particular person is a successful institutional fund manager. That's me, but you saw me already. I will just skip my intro, my bio. So let's start with supply and demand in both kind of markets. Okay, and I mean, even if we are buyers, or if we have buyers in the market, we're seeing something increasing, we have a lot of buyers, or in the flip side that we're seeing a lot of sellers. Both these actions, buying, selling, impact the price of goods, right? If we have a lot of sellers, price is decreasing. If we have a lot of buyers, price is increasing. Is that correct? I think that's very, very clear. So the only thing that only the items exchanges are different, right? We might see we have Aussie, we have pound, we have gold, we have platinum, we have oil. The only thing that changes pretty much is the asset. The asset type, the item exchange. Bulls and bears will be always there in the market. So by buyers and sellers is what reflect actually supply and demand in simple terms is buying and selling behavior. So this is how the market works. Okay, how prices are set. They are set. So how they are set is like with their prices depends on the supply and demand impact. So supply, as I'm saying in my slide over here, is when we, let's say, for example, when the price is likely to be higher than usual, because it attracts a lot of buyers, so it's keep moving. So and we have few sellers. So like my example, if there is only a couple of watermelon, sellers price is likely to be higher than usual. Then eventually that attracts other sellers. Okay. As soon as more sellers arrive, so sellers are more than buyers, then the price is likely to go lower. On the flip side, the demand is when there is only one buyer of watermelon. That was my example, and many sellers, just a few buyers, but a lot of sellers. So since we have a lot of sellers, a lot of people selling the same item again and again, so there is that competition, the price is falling. Think it like not like you're trading, think it like in the streets, like you have a lot of options, to buy I don't know, caps. There are many places that you could buy caps. That's why they are cheap, because you have a lot of options, there is a competition, so the price of the caps is falling. So if more buyers emerge, then the price will probably rise. I think that's simple. Okay, if not, question box quickly. Okay, so let's see an example of supply. Here we have a weekly gold picture. Okay, the time frame that I'm using for my examples has nothing to do with it is not important. I try to find the best examples possible. Okay, but you can find supply and demand even in a minute chart. Okay, so the fact that I use a weekly chart doesn't really matter. It's just I wanted to find the best possible illustration of supply. So here we have a weekly chart of gold between 2018 and 2008 to 2012. Okay, so with the purple line, I have connected the lower levels of the price. So you'll see that the purple line is pointing up. So this line helps us to identify whether the price of gold goes up or down. So we can clearly see that since it points upwards, the price of gold moves higher. So what that means, it means that there are only few sellers in the market, and in particular in gold contracts. Okay, so the supply is weak because we have limited sellers, but many buyers are jumping in. Okay, so there is not really a pressure on the price. That's why the price moves higher, because there are many buyers and few sellers. So we have so this is how supply could be illustrated in the market. At some stage, higher prices will attract more sellers, as I'm saying over here. So a good example of that is, we're saying that if the price is overextended, it's too high, then it will eventually go down because it was overbought. Something that is overbought, it needs to come to a balance. So it needs to come lower to find a balance, because if it's overbought, it's overextended. So at the stages where we have a very, very high prices, an extreme price, then that attracts, as I'm saying over here, more sellers. And an example like that is this circle, not red, it's a green circle that I have over here, which suddenly it jumped it rebounded sharply. So that was an extreme rally for gold, and that of course attract sellers. That's why we saw the price reversing lower again and getting back to this track, to this channel, upwards channel. So once we have sellers at this peak, at this overextended level, then that means that sellers make their gold contracts available in the market. So we have the increase of sellers, and when we have the increase of sellers in the market, then we are seeing price going lower, okay, falling. So that is what happened back in 2011, September to October 2011. Demand, an example for demand now. So again, connecting the highs of the price, we are seeing that the line is pointing to the downside. So that means that we have just few buyers, but a lot of sellers. So a lot of people selling the same stuff, selling gold contract. So that's why the price of gold is going lower and lower, because the demand is weak. Okay, we have a lot of sellers, so the demand is weak. So the supply is a lot of supply, but weak demand. So that means that we have a lot of buyers. We have just a few buyers, but a lot of sellers. So the price is going down, and it's likely to continue going down. Okay, so the only situation where you will see something like that, when we have a market that it has a weak demand to attract buyers, is at the lowest price. So at any situation like here, where it reach an overextended oversold level, then we're seeing buyers jumping in the markets in order to benefit on this extreme oversold asset. So these lower prices attract buyers. So as they emerge, the price of gold stops finding a support, and moves up on the arrival of buyers. Okay, so we have a correction of this oversold situation. Okay, so this is what happened. What usually happens when the price comes extremely down. Okay, so I don't see any questions. I assume, and I would like to assume that you're fine so far. Okay, if not, please, I'm here to help. Okay, I'm here to help. So, other than buyers and sellers, demand and supply, a very, very important and significant part of trading is our emotions, our personal emotions. It is often claimed that market participants in every single financial market, so all over the world, are so rational in their thinking and their actions that human emotions do not play a part of the market moves. Okay, the experience of many market observers, however, is presenting that the prices move, the price moves that we are seeing in our platforms, etc., etc., are often irrational and emotionally driven. So, in fact, we all know from experience, like August it's been trading for a lot of years. I'm sure that you know from experience that whatever money is involved, there is the lack of human emotions. There is no lack of human emotions. So there is no lack of human emotions. So if we invest our money at the same time, it's not only our money that we are investing, we also, because it's our own money, we earn them. We are driven by our emotions regarding to protect those money or we're getting greedy. So from experience, whenever money is involved, people cannot, let's say, remove their emotions. Whenever money is involved, there is no lack of human emotions. Okay, our mind, like it's tricky, our mind is saying buy, 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 or sell, sell, sell. It's the humanity, is the human mentality, is what can I say, it's emotions we cannot really control, but we should. If we want to be successful traders, we need to try to control the most that we can our emotions. This is a good graph of human emotions. So actually it's a great comic on human emotions. So you see the first guy is like calling and saying, I've got a stock here that could really excel. The next, the next guy, guy next to him is saying, is getting only the last two words and saying, okay, really excel. The next one heard excel, just excel. And the very third one is said sell. It's like the rumors. This is a good how the rumors are spreading out, how actually how those rumors are changing, spread it out, and how the truth is twisted. So the others hear the rumor, but as often as often happens with rumors, it get twisted. So as soon so that rumor is spread out and everyone is selling. From Excel word, we have at the end someone selling. Okay, so this is a good interpretation of rumors spreading. And the second one is when we can see a good illustration of when someone decides that he's had enough and says, okay, I'm done with it, goodbye. It doesn't take long for the crowd to misinterpret once again and twist the rumor and spread the message that okay, start buying. So a real mania breaks out. This is what I would like to show you by presenting these two comics. Okay, so this is how people misinterpret the message, twist the rumors, and then we end up buying or selling in the market. So here right now is I have plotted once again that gold chart. Okay, the same one, the weekly one that I used to present to you supply and demand. So looking back where we have chosen to sell the gold over here in this overextended situation. Okay. Sorry. So I would like to ask you, so by looking this chart, would you have chosen to sell your gold contract? Would you have sold your position at the top where over here where I have the green circle? Anyone? I assume your reply, Henry, is that you have sell. Okay, of course, this is quite obvious because you can see also the afterwards. But just to just by I need to just by having in mind what happened back then, I have to say to you that back then when we were seeing all this jump to the upside, the news actually that particular time were quite positive for gold. So everyone was like jumping in gold and buying and being bullish. So everyone was trying to catch this uptrend. So because it was a bull run for many years, and that jump higher, that rally attracted more people thinking, we'll continue going up. So let me jump in quickly to benefit as well, to buy as well. So they were actually everyone back then were actually bullish, and everyone actually loved gold back then. They couldn't but by driven by their emotions, they couldn't see the technical part, the technical behind gold, and this stall in the resistance, the resistance area around that should be around 4900s, yeah, around there. So everyone were so excited about that jump, that overextended overbought um, overbought rally, that they couldn't see clearly the technicals, that there is a bit of that the asset stalled at the 1900s resistance, and will probably and the momentum the momentum was about to correct a bit to the downside. Okay, so news were all well good. Actually, news are always good when prices are high. But we need to focus on what the price is actually telling us. The price action is actually telling us what the charts are actually say to us, instead of like being driven even by our greediness or I don't know, from different like news that's saying, okay, it's a bullish, it's up. You need to check yourself, you need to analyze yourself, you need to try uh, to see the price action, what actually it's telling you. Isn't here we can see clear resistance, a clear failure to break this resistance and move further to the upside, and an overbought. And also we are seeing clearly an overbought gold contract back in September to October. Okay, so what about the market sentiment after the after this long decline that I'm showing you and presenting to you right now? So the market sentiment refers to the overall emotional level, okay, of traders and investors. Market sentiment refers to the overall emotional level. So what we are seeing right now, we are seeing market sentiment moving lower. Okay, so that means that the overall emotional level of traders and investors in the market is is like sell because the asset will continue moving down. So so they're not really people that are interested on investing in gold in that particular time. That's why we're seeing gold going down, and since we don't have people interested, we had soonish saw gold moving below 100 after reaching the 90 hundreds in 2012. So so it soonish reached the 1,000 level. So that means that the sentiment is bad. It's always bad when prices are at when the prices are moving down, and especially when the prices are at levels where they have real potential to turn higher again. So what we mean by that sentiment is over here where we have a decline, a sharp decline, and like being with gold being below 1,000, we can see that the sentiment is bad. So since the sentiment is bad, and the price has reached its oversold area, then at this level, since it's overextended, we can say that there is the potential to turn slightly higher as a correction of this decline. And this is what actually we're seeing right here. So what I'm trying to say, just to highlight here that back then, this decline, JP Morgan said that global recovery is bad for gold. By saying that, JP Morgan is like they are saying to us, okay, sell. Global recovery is bad for gold, so it will continue pushing gold lower. Why I'm saying that? Because I want you to understand that human emotions, let me highlight that, human emotions and news can be very easily misleading. What will keep you in the market is technical analysis that will help you actually to step away from any from human emotions and any news that might mislead, might like end up misleading you. So that's why we are saying that technical analysis is extremely helpful for traders, because it will help you either to reduce the risk, but for sure will help you to remove significantly the emotions from your trading. Not completely, but at least it will provide you the most appropriate tools needed for taking a rational decision in the market. Okay, so technical analysis could help you actually to step away from human emotions and from news, and provide the tools needed for rational decision making. So this chart, I know it's not clear, it's like a diagram, is actually the S&P 500 index. Okay, so with this circle, with this blue circle, what do you think that what do you think the emotions told the investors during this period, during the period in back in 2007, where I have with a blue circle over here? Anyone? No. Someone is typing. No. So back then, what that actually? Okay. So yeah, back then the news were actually good, and there were there were some economists analysts that saying that another important U.S. stock market index such as Dow and S&P 500 in this situation, it was about um, to jump higher, like being double than that what was back then. I cannot really see how much was it, but it was, they were expecting to reach double of its price. So the goods, the news, by reading the comments and um, the forecast from this analyst, we can say that the news were good. But what what about the sentiment? Why? What do you think about the sentiment back then, back in that particular time, which was so? What do you think the sentiment was? So the sentiment was actually hopeless. Back then, the banks were full of problems with loans. We had unemployment rates quite high. People couldn't spend or buy houses. So the economy, from an economic point of view, economic perspective, things were actually really, really bad. Everything in the economy were really, really bad in the US. So the sentiment was hopeless. That's why we're seeing this this draft decline to follow that spike. So the news were good, but the economic data were awful, suggesting a very, very bad economic situation. So that's why sometimes news are misleading. Okay, so try to be prepared to read the economic data of each country. This will help you not to be misled by any kind of news. Yeah. So okay, this is what happened. People were saying buy, 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 but the situation was actually, sentiment was uh, it reached an overbought territory. So we have that decline, and at the bottom of this chart, uh, we're seeing a lot of uh, selling mania. So that's what you're seeing in this chart right now. So let's continue and let's see two main types of analysis. And of course, I'm referring to fundamental and technical analysis. Okay, let's take it step by step. So fundamental analysis, what is a fundamental analysis? Fundamental analysis actually is actually seeks to establish the value of the investment considered. While on the flip side, the technical analysis looks at price behavior, purely on the price action, on the peaks, bottoms, trends, ranges, and and with indicators you can derive, and indicators derived from the price as well. So that's the difference between fundamental analysis and technical analysis. So this information is used, it could be used from you in order to decide when to buy, sell, or just remain out of the market for now, just be on hold. By actually reading and actually trying to understand the behavior, the price behavior. This is the main difference between these two analyses. So fundamental analysis is more often long-term oriented. Okay, so fundamental information are like are mainly used from big traders in order to, and from banks or institutional traders, etc. Because they are planning to hold their investments for years, okay, for several years. Like for example, the likes of Warren Buffett or George Soros look at the fundamental informations because they are doing investments that they are long term. The investments for several years. So they might use the top down approach. So what I mean by that is that they start with an analysis of the global economic trends first of all, and then move to the local level. Focusing to study a particular the economy of a particular country. So first of all, they're seeing the global picture, and then they go through they are studying the economy per country before they invest in the market. So they actually analyze everything, the industries of that country, with banks, retailers, industrial companies, and etc. And once they found a sector that it has a future potential, then they start to look for companies inside that sector in order to invest into. So if something triggers their attention, they believe that this sector will end up will actually has a potential, a future a future potential, then they invest into that. So with stocks, meanwhile, so seeking value for longer term oriented investings. So with stocks, this involves studying of balance sheets, okay, income statements and cash flow statements. So if investors think the stocks are undervalued, they will buy them, right? And usually wait. Okay, we're referring to a long time frame. We're referring to institutional investment, etc. So these could usually wait for a few years before they consider selling them. Okay. So in the case of Forex now, for Forex market, fundamental analysis includes the assessment of a country's economical development or inflation expectations, and also central banks rate policies. We've seen how the central banks rate policies, rate announcement, etc. affects on spot, like on the release, when we can see that it has an interesting impact on the forex market. So it's not like us as retailers, we shouldn't take care of fundamental analysis. We should, because once again, we need to assess the economical development of a country to see whether it is healthy or not. If it's healthy, then its currency will be healthy as well. Okay, so it's not that we must not pay attention to the fundamental analysis. We should pay attention to the fundamental analysis as well, even for us that we are retail traders. On the flip side, technical analysis now is the study of supply and demand. So based on what we have seen in the very first few slides, about how the supply and demand impacts price action, we can understand now that circles in financial markets actually occurred as a result of changes in supply and demand. So technical analysis presents or is the illustration of this fluctuation in supply and demand. So by identifying these circles, so how the price action is moving, uh, uh, and so by identifying the circles, and trend traders seek to find areas. So by identifying circles, and trend traders seek to find areas where supply and demand's balance is likely to change. So by doing our technical analysis, by identifying where supply or demand is about to change, we know it will help us actually to enter the market at the right direction at the right time in order to benefit on this change. If we identify that supply is ready to change to demand, then we'll enter and we'll enter long. If we're seeing that demand is like this has been increased and soon as we'll have a reversal, then we enter again the market. So it will help us to get to the market the most appropriate time in order to benefit on this change. Oh, yep. So we could also say that the technical analysis is the study of trends and turning points. And why I'm saying that, because okay, the traders, like me, between you, between Jason, between Felix, between August, and etc. We have different perspectives. We have different views of the market. So since the traders have different views on whether they should sell or buy, I'm saying buy. Mohammed is saying I'm selling. So we have different views. So this buying and selling creates what we're seeing in the markets, creates these trends or circles. That's why we have also these turning points inside the trends. Okay, that's what drives the market. Also, the different view between the market participants. So if demand over a period of time is greater than supply, so prices are moving higher. So here we are seeing that demand is greater than supply, so more bulls than bears. So the price will move higher in the trend. We are interested in benefiting from these trends, right? So by using the circle turning points inside the trend, we will actually benefit by this trend. If you identify these turning points, you can enter and actually benefit on this trend. So by seeing this jump higher, this overextended, overbought price action outside from the trend, and by checking that whether the sentiment has changed from bullish to bearish, you can enter short over here and benefit again on this trend and on the return back to a to an upwards channel. I have some questions. Okay, I will check the questions afterwards, guys, because we have few more slides and I need to cover everything. Yeah. Okay. Quickly. Circles in nature, market circles. Circles are a natural phenomenon and occur everywhere around us. Okay, so let's look at them. So there are circles in the financial markets. You can see it's moving up, down, up, down. It might repeat. We must see the same behavior happening 5 years ago and see it happening again this year. We might see the same behavior last week and again repeating itself, moving the same pattern once again. So markets The same as nature repeats itself, it creates some circles and repeat those circles. So there are circles in the financial markets, but we can find them also in nature. So what I mean by that, we have seasons in nature, right? Winter, spring, summer, autumn. But there are many kinds of other circles, like sunspots have a circle of about 11 years. There are areas on the sun surface that they are affected by magnetic activity, which reduce the surface temperatures. That's why they are visible to scientists as dark spots. So a sunspot in an area. So it's like we're seeing this circle every 11 years. You see, isn't it the same? This solar circle repeats itself. It lasts for 11 years and it repeats itself again and again, again and again. So you have a circle in nature as we have a circle in the markets. Circle in the markets like that. Up, down, up, down, up, down. Every, what was it? This was between 97 to 2002, so 5 years. Then 5 years, we have seen an up and a down move. Another in the next 5 years, we have an up and a down. Circle. Same as in nature, with the sunspots, that's an example. With global temperature as another example. This is a monthly value of global temperature. We can see up, down, up, down, up, down, up, down, up, down, down. Big one. Again, the same situation. Again and again, it repeats itself. Long-term circles including short-term variations. The same circles that we're seeing everywhere in the nature can be seen in the markets. So market repeats itself, repeats the same patterns. History repeats itself. Okay, this is an example in this Aussie New Zealand monthly chart that the long-term circles are clearly visible. Once we move from monthly level to daily level, we can still see that. Let me move and actually justify that to you. Here is the monthly one that we just saw, and in this circle we have the daily chart. You see, again a repetition, down, up, down, repetition. We find similar circles in the daily chart as well. So markets repeat themselves in every single time frame. You can find circles in every single time frames, and you need to learn to benefit on this circle. So by identifying such a circle in every single time frame, even in the hourly chart, you could benefit because you know that, oh, it went down, it found support, so it's repeating itself. It seems that there is no move to the downside, so we'll go up. It's a circle. It's going up, down, up, down, up, down. Okay. So how you could actually, I'm saying all these about circles, about price repeating itself, etc., but how you could actually find a way of recording the price movement. So what's the way of reading the price action? So chart number one, we'll have three of the most common types of price actions, price charts, and how you could read them. So in the first chart, we have okay, first of all, we have three types of price movements. This one, the line candle, the bar chart, and candlesticks. I'm using candlesticks. I love them. I can easily read them. It's up to you. I don't know if there is anyone that actually use the line chart or the bar chart. I'm using bar chart. I'm using candlestick. I love them. So in the first line, just quickly, I will simply say that it records only the last price in the time period. So the closing prices are then connected and give us this single line. So with this chart type, we cannot see, or we don't know what was the high price, what was the low price, where we only know where it opened and where it closed. That's it. In the second chart, which is the bar chart, these bar charts are actually recording the open, high, low, and close price. Okay, open is marked with this small horizontal bar to the left hand side, and close is like recording this small horizontal bar to the right hand side, while the high and the low are the edges of this vertical line. So here's the low price and here is the high price. Okay, this is how the bar charts could be read. The most commonly used and the most beloved one is candlesticks, Japanese candlestick patterns, Japanese candlestick charts, because they could more easily be analyzed, being studied. We know that if it's white, I'm using white and blue, white and red, sorry. In this situation, the example is white and black. So we know that this is a bullish candle, so the price went up. This is the lowest level, this is the highest level, and this is the open price and close price, but it's bullish. By just without getting any attention on the high, low, open, and close, you know from the color that you can set. By the way, if you want the upwards movement to be white or red or whatever, you can set it. So by just checking and say, it's white, it's up, down, down, up. It's more, they are the ones, the more popular ones, and they are, and you don't have to pay too much of attention to read them because they are very, very easily, they are very readable, easily readable. So let's move in. Why? Next chart. A candlestick bar now with a white body. This situation tell us that the price is moving higher. I already said that. During a particular period of time. Let's say I'm in a minute chart. I know that in a minute my price went higher. While this is the low price at the particular minute, and this is the high price at the particular minute. This is the open price, and this is the close price for the particular period. If you are in a minute chart, 30-minute chart, 1-hour chart, 4-hour chart, etc. Okay, the peak and the bottom of this bar is the highest and the lower price traded during that period. The black body, bam, bearish move, decline. So move down. It opened over here, it closed over here. It tried to push further to the upside. It didn't manage. This is the high level, and it moved down since then. It tried to push further to the downside by forming this low level over here, and it closed there at the bottom, at the end of the period. So down, easy busy. Okay, sorry, I forgot that I had these arrows and these explanations. Here it is. This is what I just mentioned to you. Open, close, high, low, and etc. Lost sound. Why? You hear me? Can you hear me? Can you hear me, guys? Anyone? A drop. If we do not have the others. Yes, Sibusha, just saw your comment. This is recorded and you have it on YouTube as soon as we close the session. Okay, hola, Lega. Yeah, indeed, you need to focus on resistance support, but how you will identify resistance support levels? You need technical analysis. You need to take care of what the price actions, the price movement is telling you. Identify a good and accurate and the best possible support and resistance level in order to reduce the risk reduce the exposure in the market, reduce the risk for your trade, and benefit on it. No sound. Yes, I can hear you. Thank you. Good. The audio is breaking. Okay, I will request for another headset. Maybe something went wrong. Maybe it's like okay. So just to show you that the color doesn't really matter, I like seeing white and red. White for me, because I set my platform like that. White for me is when the price moves higher, so bullish candle, and red is when the price moves lower, so red candle, bearish candle. By default, if I'm not wrong, in the MT4, by default you have green and red. I think it's green and red. So green presents the price moving higher. The red bars represents that the price is moving lower. Okay, simple as that. Okay, patterns. Okay, we have a lot of webinars for patterns, so I will briefly go. How to delete horizontal lines that I draw on the chart? Select it, right click delete. If you can't find that, this is my chart. So right click objects and delete them. Okay, let's go back to the slides. Patterns. There are many different candle chart patterns, okay, with fairly exotic names. So one of them is morning star, evening star, the ones that I posted over here. So it's quite challenging to remember all these, but by experience, you're getting to remember. Like, so an example to help us to understand the patterns and some examples of them is this one. So morning star is when we have, okay, when we have the price is in a decline, it's moving lower, lower, and lower, it's moving lower, and then suddenly it's stuck, cannot go further. It's like it's finding a support over here, and it cannot move to the downside. And suddenly we are seeing few bars, few candlesticks to the upside. So this is a morning star formation. So when we see at the bottom of the downtrend a strong bearish candle and then a doji one. A doji, when I mean in doji is when the open and the price action are the same. The open and the close price are the same, or there is it's a tiny body. The candle has a tiny body. It's not big. It's a tiny body. And then the third candle is a bullish one. So the first one is a part of a downtrend. The second candle has a small body, and the third one closes positively, but above the halfway, the midpoint of the first bar. So the closing price of the third is above the midpoint of the first bar. That means that it managed to recover more than 50% of the losses that we have seen in this last candle. Okay, this last downtrend candle. That's a morning star, and that's a bullish formation. If we see something like that, we can say that, oh, this is a bullish pattern, so the asset will go up, the price will move higher. On the flip side, we have evening star, so it's suggesting the opposite. It's a bearish candlestick formation. So we are in an uptrend, but suddenly we have seen that it's struggling to move. The price is struggling to move further to the upside. So we have this doji candle forming this very small body candle, and suddenly we have a drift to the downside. The price is moving lower, and actually close below the midpoint of the first candle. Sorry. So it closed below the midpoint of the first candle. So that's a bearish formation, and that suggests that the price will continue moving lower. Okay, so you can enter short if you identify something like that. Just briefly, quickly, a quick look of the history of how Japanese candlesticks came about. So as we all remember, some things have not changed over the last 200 years, and so now the candlestick charts remind me that I actually have a connection with Far East. So we can say that that's of course that's the Japanese trader, Rice traded, is the father of Japanese candlesticks. So is the creator, is the founder of the candlestick formation. It was a Rice trader. So it's the one that managed to link the supply and demand for the rice. So so the markets were strongly influenced by and he actually identified that the markets are actually influenced. The price of the market, the price of the asset is actually strongly influenced by the emotion of traders. You can Google his name to find more things, to find some pretty vivid images. So that was the father of candlestick patterns. I don't want to spend time on this though, because we have more to cover. It's not significant as long as you understand how to read a candlestick, a Japanese candlestick. So here, we said that when demand over a period of time is bigger than supply, the price is moving higher, right? So connecting the lows of the price action, you can see that the trend line is pointing to the upside. So you know that the price moves higher. So this trend line is actually another technical tool that you can use in order to define where the trend is pointing. Is it pointing to the upside or is it pointing to the downside? So this example is pointing to the upside by connecting these lows. You can see that the trend line is pointing upwards. So what we actually did we connected the support points. And actually, by connecting the support points and having this trend line, what you need to do next is to identify or trying to look for some buying opportunities in order to jump in the market on the direction of the trend line. So you have to look to buy the next time the price approaches again the support. And by saying support, I mean the trend line. This provides support to the asset, to the price action. Here are two examples of where that we had a buying opportunity. Okay, when the asset actually, the price actually approached the trend line. That's the continuation of the particular example. So we're seeing that it continue moving to the upside in an upwards channel. So we have a upwards trend over here, where there were several opportunities that in which the price action approaches the trend line, and you could actually get to the market by buying at or close to the trend line. Okay, let's continue. Let's see the a downtrend example. So when the supply is greater than demand, as we mentioned in the beginning of this webinar, the price tends to go lower, right? So by connecting this resistance by connecting these highs, which are acting as resistance levels for the price action. By connecting those highs, we have a trend line that points to the downside. So once again, you can use this trend line and look for some sell opportunities in case that the price approaches and find the resistance on the trend line. Okay, so let me up. So this was an opportunity over here when it managed to, it approaches the trend line but didn't manage to break it, so it moved lower. So that was a selling opportunity. Another one over here, and etc. So you should, by having the trend lines actually help you to identify entry points when the market approaches the trend line. Here we have a sideways move. So this is when the supply and demand are in balance. That is when there is indecision in the market. So they are moving in a range. The price action is moving in a range. Supply and demand are in a relative balance, as we're saying. So the price moves sideways. Okay, sideways move is also it could be still tradable, if I can say, but in a short term, with short term expectancy for a price move. Okay, so since the market is in a range, you can see it's going up and down between the same levels. So this is the lower trend line of the range, and this is the upper trend line of the range. In a range bound, the buyers are actually looking for an opportunity when the price action comes closer to the support line, to the low barrier, to the lowest barrier of the range. So this is a buying opportunity when it approaches and rebounds from this support line. Okay, so another one is over here, etc. So on the flip side, the sellers are actually buying, are looking for opportunity to sell when the asset reach or approaches the resistance line. Okay, that's that. And we are already a quarter past 3 o'clock. So the last part of our webinar for today is the moving averages, technical indicator, the most famous and commonly used technical indicators, moving averages and Bollinger Bands. So we will have a quick look of two of the most significant moving averages and a momentum indicator, which is Bollinger Bands indicator. So in this example over here, I have with a red line the 50 period moving average, and with the blue line can you see my, yeah, okay, with the blue line the 200 period moving average. So first of all, let's take it step by step by explain to you what I mean by moving average and what I mean by 50 and 200 period moving average. So the 50, this red line over here, the 50 period moving average is actually taking the sum of the last 50 closing prices. So let's say that we are in a daily chart, okay? So today is Wednesday. Today, the moving average will take the sum of all the last 50 days, the closing price of the last 50 days, okay, and divides it by 50. So in order to find the average, this value will then be plotted on the price chart, and this is happening every day. This calculation is repeated every day. So by plotting the values, we have that single line by plotting the average values that we have calculated every day and connect them with a line. We have this 50 period moving average. This is why we have, as a result, a single line, a single moving average line in our charts. You could have a moving average line in every single time frame, daily, daily, monthly, 1 hour, 4 hour, etc. Okay. The blue line, which is a 200 period moving average, it's again is the sum of all the last 200 closing prices divided by 200. So what these moving average lines are saying to us, or how can be used to define the trend, is like, for instance, over here you can see that the red line, the 50 period moving average, okay, is moving below, is moving first of all, it's moving above the 200 moving average and below the oops, sorry, going back. So it's moving above the 200 period moving average and below the actual price action. So that suggests that since the short, the smaller moving average, the 50, is above the 200, then that suggests that the price, it is likely that the price has been trending higher in the near future, okay, in the short term. Sorry. Okay, so okay, someone, we have some questions. So a trader who introduced me suggests using 7 and 14 moving average period. Is this also acceptable? Okay, Felix. Depends on your time frame and whether this moving average, these settings are actually suitable for your trading. If you are an intraday trader, and by saying intraday I mean an hour, you're trading in 1 hour chart or 30-minute charts, of course you need to change the settings and maybe reduce them. Maybe if you're in an hour, if you are trading in an hour chart or 30-minute chart, you might use let's say 5 and 9 period moving average, but it depends on your trading strategy and which time frame you're trading, and whether by changing the settings of moving average are actually giving you reasonable results. So you need to test it, okay? The 15200 actually work quite well in a long time frame, so daily and above. If you're trading if you're an intraday trader and trading in a very tight, very small time frames, then of course, yes, you might need to decrease, to change the settings of moving average into smaller ones in order to give you accurate results, or at least the most possible accurate signals. So yeah, I don't find that 7 and 14 is bad, as long as it suits your trading style and actually gives you a good signals on the particular asset that you're trading in the particular time frame that you're trading, okay? So Alaleka, I'm not sure what you want me to repeat. Is it regarding the question that Felix just posted, or what actually is the period, the moving averages, and how we could read them and analyze them? In general, guys, you need to know that so here we have 50 and 200. If the short, the smaller the smaller period moving average is above the long one, so like here 50 is above, is moving above the 200, then that means that the price action is moving to the upside. On the flip side, if the 50 is below the 200, then we'll probably have a decline. We'll see the asset moving lower, the price is moving lower. Okay, so the same reflects to every single time frame, daily, and etc. Yeah, you could keep it. I'm using it as an exponential moving average, though. Exponential moving average give a more fast and smoother line. But again, check, test them. Does it suit your, I don't know, your Aussie 4-hour chart? If not, if it doesn't comply, if it doesn't, it's like opposite of what the candles are presenting, then you might consider to change in the settings. Okay. Like for example here, this is my 200 and this is my 50-100. So it's over here had the 50-100, the 50 period moving average moving below the 200, but at the same time my price action is moving lower. So that's quite wrong. So I need to change to maybe, let me flip to simple. Sorry, let's flip to simple ones. And I need to reduce. Let's see if I reduce to 20, actually 10. Let me change that to 10 and 20. Let's see what happened. So, what I have just done? Okay, 9. 9, and where's my red line, my red moving average here? And 20. Okay, what I have done? 20, isn't it? Yeah. Right. Close. Okay, so that gives me quite good signs, because you see I have this cross of, I change it to, this is a 9 simple moving average blue line, a 9 period, and this is a 30 simple moving average with so the short is the 9 period moving average is with blue, and the 30 is with and it's with the red. And don't forget we have the 20 over here, which is with gray. So we can see that here the short one cross the longer ones, the 20 and 30, and move above it, and actually that coincides and agrees with the jump in Aussie dollar on the 3rd of September and on this up rally to the upside. So you need to test, okay, you need to check in order to give you the most appropriate signals possible. Okay, so let's continue. Last but not least, and it's already been 20 minutes, an hour and 20 minutes, so I need to soonish end our session. Last but not least, we have Bollinger Bands. Okay, as based on the name as well, it took their name from John Bollinger, the founder of this indicator, this technical indicator, back in 1980s, which was actually a long time technician of the markets, and that's why he developed this technique for identifying the momentum in the market. So he actually developed this indicator by using moving averages. Using moving averages and the trading bands above and below the moving average. So he wanted to find the range to identify a range at which the price action is moving. So what this Bollinger, so what you're seeing over here, the Bollinger Bands is these green lines, and this one in the middle. So Bollinger Bands indicator, which is that one, these green lines, this range, in which the price action is moving in, is simply the latest, the recent volatility to the moving average, and which actually results in a band above and below the moving average. So we have a band, we have a range. So the upper line, okay, is when is actually the upper the volatility above the moving average, while the lower line is the volatility which is subtracted from the moving average, and that's why we have this lower band. So what I mean by volatility, I'm referring of course to the relative rate at which the price moves above or moves up or down. So if price is moving a lot, let's say we have a trend, a trend, and we have, let's say, price moving higher, then the Bollinger Bar will move along with the price action, okay, and will subtract or up or at on the moving average of the price, in order to create this band in which the asset will move, the price action with the price action will move. So in case that we have a price moving sideways, so the bands are getting closer to each other. So an example of something like that is do I have here? Can you see? The bands are very, very close to each other, so that reflects a sideways movement, and that suggests consolidation in the market. Okay, let's move on. Already mentioned that it defines the price needs to be by defining the price needs to be moving higher. We have the first important condition for buying. So okay. So Bollinger Bands, as I mentioned, they are defining the range of the price variation, right? So if the price is trending to the upside, we have an upwards trend. It is unlikely the price to move outside the lower band because we're in an uptrend. Okay, so it will sustain and move within this this range. So this actually, in case that it moves close to the lower band, this is similar to what we said about trend line. This gives you an opportunity to participate in the market, attracts buyers over here, and it's an opportunity, it's a buying signal when the price actually approaches or even cross below the lower Bollinger Band line. This is a buying signal. Okay. Oops, sorry. Okay. So these Bollinger Bands are actually giving you a direction of the overall trend, but also giving you help you to decide when is the where and when you should enter the market, either in this situation in a long trade, or if we were in a downtrend in a short trade. So it can help you identify the correct time to enter the market and your entry point as well. So here is again another example. We were in a bit of a decline. So when the asset approaches the upper line, it was a buying opportunity, a selling opportunity. Sorry, when it approached approaches or broke the upper line of the Bollinger Band, it was supposed to be a selling opportunity, while when it actually the asset reaches the bottom or even breaks the lower line of the Bollinger Band, then the trader should look for a buying opportunity. Last but not least, because I need to close, I need to end up the session, how to read Bollinger Bands. So first of all, I need to highlight over here that yeah, we already mentioned that when the asset price reaches the top and the bottom, or even breaks the top and the bottom line of the Bollinger Band, we have some signals of buying and selling, some buying and selling signals. So because when the price actually reach the bands, the upper and the line bands, which this means a possibility of trend reversal, okay? Because they act as support and resistance levels as well. So that's why when the asset, as I mentioned here, reaches the top, that's a sell opportunity. When the asset reaches the bottom, is a buying opportunity. But if you see an entire candle being outside of the Bollinger Band, like here or here as well, then that's the probability of a reversal is even higher than usual. So you need to check also what the other indicators are telling you in order to have a confirmation for the possibility for the reversal of the trend. Meanwhile, once the price hits either the upper or the lower band, then tends to move, then what we're saying is that the asset will tend to correct, so it should tend to move back into the middle line of the Bollinger Band. So for example, when it reached this top over here, even though it didn't close above or it didn't break the upper Bollinger Band, by approaching this top, the top of the Bollinger Bands, then we can say that the price it usually tends to move back to this middle line of the Bollinger Band. So this is another sell opportunity with a target being set at the middle line of the Bollinger Bands. If it reaches the bottom, then the asset tends to again move back to its middle line. So again, you could this is a buy opportunity with target being set at the middle line of Bollinger Bands. In the case that we have a break of the middle line, like here, then we can say that if it's a break above the middle line, then the asset tends to retest in the near future the other band. So in this case, it will likely test the upper Bollinger Band line. If it breaks below, like over here, there's a clear example. If it closes and breaks below the middle line, then it tends to move to the other band. In this case, I'm referring to the lower Bollinger Band. So yeah, so that's it, guys. I try to cover all. We managed to cover actually some of the market basics, and hopefully I help you to understand some of the fundamentals in the market, such as what's the difference between fundamental and technical analysis, how the human emotions affect the trading, what the different chart types that we have, how the charts could be and study and analyze, two of the most commonly used and famous technical indicators as a moving average and Bollinger Bands. So we have reached toward the end of our webinar. So if you have any further questions other than the ones that I already reply, now is the time to stick them in the box, because I need to finish close the session. We're nearly an hour and a half here. So I have replied to Fred. Can you send a record of this video to us? Yes, it is recorded. So as soon as we end the session, the support team and marketing team will send you a recording of this session, so don't worry about it. And I remind you that it will be, we have part 2 next Wednesday with Stuart. Okay, so let me also present you our forthcoming webinars, so you will have in mind and identify the ones that you're mostly interested in and you would like to attend. So these are the upcoming webinars. Tomorrow we have advanced trading strategy with Otto, live analysis like every Tuesday. You are more than welcome to join and ask Stuart to analyze you any asset that you wish, or to discuss also how the fundamental news are actually affecting the market, and to see also some technical analysis, live technical analysis by Stuart. Next Wednesday, as I mentioned, is understanding market basics 2. So it's the follow-up of this webinar, of today's webinar, in which you will see in more depth some of the price formation and patterns. So today we only saw evening and morning star. You will have the chance to get familiar with some of the main types of price formations and patterns. See a few more oscillators such as RSI, money flow index, and stochastics, and how you could combine indicators with the price formations in order to have a complete and a complete technical analysis of the market. So how you could actually to learn how to read these indicators and to combine indicators with price action. Do I have to set Bollinger Bands just like the moving average depending on my time frame? Yes. Okay, by default, we have 20 period moving average in the, over here. Yeah, by default, you will probably have a 20 period moving average in Bollinger Bands. I'm not usually changing the settings for Bollinger Bands because I'm like checking hourly, 4-hour, daily charts only. But if you are in a 30-minute chart, you might consider changing them. But I don't believe that's the case for Bollinger Bands. The default settings are quite good. The only thing that you might consider changing in the Bollinger Band is the deviation, maybe reducing the deviations instead for 2, maybe 1.5, just for having faster signals. But take care, because if you set it, if you try to reduce it, to reduce in order to get extremely fast signals, sometimes will not be accurate. So check, does it give me accurate signals like on time signals, etc., or not? So, but you could of course amend, but test before you actually change it. The setting for moving average is different, Jim. So the green are my Bollinger Bands and the blue and red are my moving average. So two completely different indicators. Yeah, by changing the Bollinger Band, it doesn't affect automatically, at least the moving average. You need to just manually change it by yourself. Okay, two different indicators which could be found in this navigator over here below the trend section. Okay, so thank you for watching, guys. I hope you're having a great day ahead. We have FOMC today, so take care and see you again next week. Bye bye.